This week we saw panic selling, a broken AI narrative, but also a hidden $100 billion liquidity boost and a new leveraged spot Bitcoin product in the making. And all of this could set up the next big move for crypto. Hi everyone, this is Mindaugas. I analyze crypto charts, macro trends, and on-chain data for long-term investors. This is not financial advice, just my personal analysis. If you enjoy clear and honest market breakdowns, subscribe and let's dive in. Let's start with what actually happened in markets this week. We moved from strong risk-on rally on Monday to a broad panic sell-off by Thursday. At the start of the week, traders were celebrating the U.S. government reopening plans. Shorts were being covered, risk assets were bid, and both stocks and crypto pushed higher. But as the week went on, three things hit sentiment at the same time. Continued heavy selling in AI-related stocks, weaker macro data, especially in the labor market, and a more hawkish tone from several Fed officials, which cut the odds of a December rate cut down to around 50%. In this environment, gold was one of the only clear winners, while the dollar, treasuries, Bitcoin, and equities all pulled back. On these charts, you can see the story in one glance. Gold is strongly up both over the last week and year-to-date. Bitcoin and Ethereum saw a weekly pullback. Stocks and bonds sold off together, which is rare and usually signals stress. And volatility, measured by equity and bond volatility indices, snapped back toward the 20 level, showing that fear is coming back into the system. Now, let's zoom in on digital assets. Since last Friday, crypto has been extremely volatile. After a strong early week rally, Bitcoin failed to hold strength and briefly broke below the $98,000 level, hitting its lowest point since May. XRP was one of the few bright spots. It jumped as much as 8.5% on November 10th after news of 5 ETF approvals. Privacy coins, which had rallied strongly last week, corrected hard. ZC, for example, moved down from around $764 to roughly $500. Here you can see how BTC, ETH, XRP, BNB, SOL, and the broader altcoin basket have performed year-to-date. Bitcoin is still positive on the year, but the recent pullback is clearly visible, especially compared to the strong performance we saw earlier in the cycle. In the middle of all this noise, there is one structural story that, in our view, the market is underpricing. The acting chair of the CFTC, Caroline Pham, confirmed that the agency is working with regulated U.S. exchanges to launch leveraged spot trading for Bitcoin and Ethereum, potentially as early as next month. This is a big shift for several reasons. For the first time, regular U.S. users will get access to leveraged spot products, not just futures. These products will sit under the Commodity Exchange Act with strict margin and risk management rules. And they reinforce the view of BTC and ETH as commodities in this regulatory framework. According to our estimates, U.S. regulated exchanges hold roughly $265 billion of BTC and ETH. If just 5% of that capital uses 5x leverage through these new products, that already creates more than $50 billion of additional buying power, about the same as all net inflows into Bitcoin ETFs up to July 2025. Right now, this story is being overshadowed by macro fear, but structurally is a strong potential liquidity boost for Bitcoin and Ethereum over the next 6 to 12 months. Another important piece in our framework is the relationship between gold and Bitcoin. Historically, gold often moves first, and Bitcoin tends to follow with a delay of about 10 weeks. Since September, gold has started a renewed uptrend, breaking higher as investors look for safety. In this chart, the yellow line is gold, shifted forward by 10 weeks, and the black line is Bitcoin. You can see that when gold sustains a strong up move, Bitcoin frequently catches up a few weeks later. If this pattern repeats, late November and December could become a more supportive window for crypto, assuming we don't get a fresh macro shock. Before we move deeper into macro data, it's useful to see how Bitcoin is currently correlated with other major assets. Over the last 2 months, Bitcoin and Ethereum remain highly correlated, around 0.86. They still trade as one risk cluster. BTC keeps a clear positive correlation with the S&P 500. When equities sell off, Bitcoin usually feels pressure as well. Correlations with the dollar index and the US 10-year yield are mildly negative. A stronger dollar and rising yields are usually headwinds for crypto. So when you see AI and growth stocks selling off and bond yields moving higher at the same time, it's not surprising that Bitcoin struggles in that environment. Let's talk about the macro cracks that really shook sentiment this week. The main stress point is the U.S. labor market. This chart shows the recent ADP weekly employment data. Over the 4 weeks, ending October 25th, private employers cut around 45,000 jobs in total. That's a clear shift compared to previous months, and it points to a slowing economy. Goldman Sachs now expects a decline of 50,000 jobs in the October non-farm payrolls report. If that happens, it would be the weakest NFP number since December 2020. At the same time, layoff announcements have surged to their highest October level since 2003, and small business optimism has dropped to a 6-month low. In simple terms, the job market is no longer a source of strength. It's turning into a risk factor. On the policy side, several Fed officials, including Collins, Bostic, Kashkari, Musalem, Hammock, and Goolsbee, delivered hawkish or at least very cautious comments this week. Their message was that the bar for further rate cuts in the near term is still high, and that inflation remains their main concern. Because of this, the market's expectation for a December rate cut has fallen from about 70% last week to roughly 50% now. For risk assets like Bitcoin, that combination is tough. Growth looks weaker, but there is still no clear promise of easier monetary policy. Now, let's look at one of the most interesting charts in our research, the U.S. Treasury General Account, or TGA. Think of the TGA as the government's main cash account at the federal. When the balance falls sharply, it usually means money is being pushed out into the financial system, and that can support risk assets. Right now, the TGA balance is at its highest level since 2021. With the government shutdown resolved, a large part of this cash will start flowing back into the economy over the coming weeks. The Treasury's stated goal is to bring the balance down to around $850 billion by the end of Q4 2025. We think that in practice the balance may temporarily drop below that level, which would imply a net liquidity injection of more than $100 billion in a single month. This second chart compares months when the TGA fell by more than $80 billion with Bitcoin's performance. Since 2013, in those months, Bitcoin has risen about 61% of the time, with an average gain of 8.8% and a median move of 2.7%. It's not a perfect predictor, but it clearly shows a positive relationship between TGA liquidity releases and Bitcoin performance. When you combine this with the upcoming leveraged spot products and the recent strength in gold, you start to see that the medium-term backdrop for Bitcoin may be better than this week's price action suggests. Before we wrap up, let's look at the key events for the coming week, because these dates can drive a lot of short-term volatility. On this calendar, you can see the main macro and crypto events we're watching. November 16th, Japan GDP growth. This can influence the Bank of Japan's policy and risk appetite in Asia. November 17th, DevConnect 2025 in Buenos Aires, which could bring major announcements for the Ethereum ecosystem. November 18th, Japan's trade balance for October, again important for BOJ expectations and global sentiment. November 19th is the real cluster. U.S. FOMC minutes, U.S. building permits and housing starts, and NVIDIA's earnings report, which can move the entire AI and tech complex, and with it, Bitcoin. November 20th, U.S. existing home sales and Japan inflation data, both relevant for how central banks see growth and prices. For crypto, the key message here is simple. If NVIDIA disappoints and housing looks weak, we could see another wave of risk-off selling. If the data is soft but not disastrous, and the Fed minutes sound more cautious, markets might start to reprice easier conditions again. The second table shows how messy some of the upcoming U.S. data releases might be after the shutdown. Some September reports have already been released. Part of the October data may be skipped, delayed, or combined with November. In several cases, agencies may rely more on estimates and partial samples. That means we should be prepared for surprise releases outside the normal calendar, and potentially lower quality data, which makes it harder for the Fed and for markets to read the true state of the economy. For us as crypto investors, this simply means expect sudden volatility spikes around headlines and be very careful with high leverage during these windows. To sum everything up, this week we saw the AI narrative crack, labor market data weaken, and Fed officials push back against aggressive rate cuts. That created a classic macro shakeout. Stocks and bonds fell together, Bitcoin moved lower, and gold became the main winner. At the same time, under the surface, several important tailwinds are building. A potential CFTC green light for leveraged spot BTC and ETH in the US. More than $100 billion of liquidity set to enter the system through the TGA, and a renewed uptrend in gold, which historically tends to lead Bitcoin by around 10 weeks. Short-term, volatility is high and sentiment is fragile, so risk management is crucial. Medium-term, the combination of new liquidity, structural adoption, and the gold signal suggests that the next strong move for Bitcoin could actually be to the upside, once this macro fog starts to clear. Thanks for watching. This is Mindaugas. Subscribe for weekly market updates and clear crypto analysis. See you next week.